thank you for joining us here for the ByteTree webinar. And the subject, as always, is Bitcoin and gold in 2022. And I'm Charlie Morris, the Chief Investment Officer at ByteTree, and it's my pleasure to be joined by Mike McGlone, who's the Senior Commodity Strategist at Bloomberg. Hi, Mike.
Hey, Charlie. Thanks for having me. I've enjoyed getting to know you and talking about gold and Bitcoin. Looking forward to today.
Good. Now, Mike, I just want to tell you, because in case you think this is for investment advice, it isn't. There's no investment advice here. This is purely entertainment.
Yeah, pure entertainment. But the key thing I do at Bloomberg Intelligence is I'm completely neutral, which is I love. I just publish, and I don't have a bias anyway. But I have views, and I'm not allowed to give investment advice. So, hey, if I think gold's going up, that's just what I think gold's going to do. So people do what they want with that, with my views.
That's not advice. Good, that's clear. So we're just going to go through the next 30 minutes, maybe longer, if we can find enough interesting things to talk about. I hope we will, about the subjects around us. Now, obviously, Bitcoin's had a torrid time in the last few weeks. Gold's actually been pretty flat this year. So we'll try and talk about these things and what are driving them and where it's all going. So I'm going to share my screen, and we're going to kick off with a couple of slides. So first things, Mike, if you don't mind, just talk me through the dollar. You've got this, you gave me the trade weighted dollar chart. Most people look at the DXY. DXY is 105 right now, so if people are confused looking at this at 119. And this is the broad dollar index. I believe it includes some more emerging markets. Is that right?
Yeah, well, it's a Federal Reserve traded index, so it's not real time. But from a commodity guy, it has the highest beta and correlation and negative correlation to most commodities historically. And the data goes back to 1975. They publish it daily. I think the data is from history is back weekly, but it's based on the amount of trade that U.S. does with other countries. So right now it's about 20% weighted. China is the highest trade. Canada's in there, and it's all the rest of it's probably Europe. The big difference is if you look at the DXY, it's mostly dollar versus the euro. And this is enduring. It's a long-term trend, long-term method. And I've always used it for indications with commodities. And partly you can see there, it's the key thing you remember about the dollar. It's a lesson I learned, and I like to use the Churchill quote about democracy. It's the worst form of government except for all the others. And the dollar is the same way. I think we all get that. The chart shows that. Historically, it goes up versus fiat measured currencies. It doesn't go up versus versus gold, but the dollar does, and it's just starting to resume that upward trajectory, I think. But you can really see that with what's happened with a lot of the other major currencies here this year: the euro, the yen, and with the exception of the ruble.
I think Jim O'Neill would call that a growth stock and say that's a cup with a handle chart pattern. That's quite scary, isn't it? And we're hoping we're near the top of the dollar, and if that breaks out, putting one's chart hat on looks like a start of something rather than the end of something.
Yeah, so that's one of the things I'd like to point out, and I've done it a lot in terms of the dollar. If you're bearish the dollar, give me an alternative. Gold's a great alternative. I think Bitcoin's a great alternative. But on any other currency on the planet, is there a higher yielding one that has 11 aircraft carrier battle groups? And then, if old man, tanks come down from Russia, who are you going to call? Old man Joe? Joe Biden? I mean, it's just the way the dollar is. It's just the best place to be. It's the least worse. And it's still, I think it's kicking in this year with the war accelerating in Europe and what's happening in Russia and even China pushing back in free market capitalism. People have realized, all right, well, we got one choice. What are we going to do? Dollar, Swissy, euro, we're going with the dollar.
I couldn't agree more. Dollar's the only major liquid fiat currency that's credible. But with that comes problems because, I think the US is, I'm approximate here, but about 25% of global GDP, and the dollar's, twice that of trade. So it is a massively overweight currency in terms of global financial activity, which probably gives it a natural premium. And that, when it's going up too much, that causes pain around the world.
Well, there's one key quote I'll kick in and lead to the next one, and that was from Larry Summers. He said, when people are pushing back on the dollar, he says, it's like this. His quote was, what's the competition? His quote was, Europe's a museum, Japan's an old people's home, China's a prison, and Bitcoin's an experiment. Among those, to me, the most likely to really succeed is probably the experiment. And part of that is gold.
I think that's brilliant. You've got to love people like that. Okay, let's talk about this last 6 months. There's a chart I published today in a report. The report was called Canary in the Coal Mine. It's on the internet and free to all. So this is priced in US dollars. We've got gold that over the last 6 months is up. $100 investment now has given you $101, which is very good for this year. And everything else has gone down. And in blue, I've cheekily snuck in the ByteTree Bold Index, which combines Bitcoin and gold. Then in red, we've got the NASDAQ. So $100 is now 71. Then we've got the 30-year zero. So that's the US 30-year bond, which is down a lot. And it's actually down 50% since the peak in 2020. And then we've got Bitcoin, which is obviously down a lot in the last few days. Bitcoin had been following the NASDAQ down until the end of April, then decided the NASDAQ was a little bit stronger, so it would have a go. It would take a jump lower and see if it could match 30-year bonds, and decided to go a jump lower and match the non-profit tech stocks. So it's kind of, I was really, really excited about it to go, because this whole Bitcoin being of a NASDAQ and a bear market was pretty exciting to me. That's not an arc, but clearly that hasn't followed through. And the surprising thing for me, Mike, is that the on-chain data that we follow so closely hasn't slowed down. The Bitcoin network is alive and well. This is purely a repricing.
Well, what's one thing I really appreciate about getting to know you, Charlie, is how we are similar backgrounds in economics and watch very similar same things. I started trading in the bond trading pits of Chicago in the 80s, and I just always loved trading zeros. Long-term zero coupons are the best thing to trade. And the way they're plunging this year, to means they're going to come back. But what I think the key thing to take away from this chart is the ebbing tide is in all risk assets, and the riskiest assets have been cryptos, and they got the most speculatively excesses. I mean, the excesses of excess in cryptos were shocking last year, and we're just taking those out. But the way we're going to come out of this is Bitcoin's probably going to come out ahead like it has. And I think this chart just shows the rule of don't fight the Fed. That lesson of the last 40 years or so, those of us who remember, the stock market crash, of the Fed being there to ease every time that markets went down, it's done for a generation. I think it's over. And that means how you can invest in the future. And that's where I see eventually Bitcoin, that this combination that you and I talked about earlier, this combination of Bitcoin and gold is potentially one of the most upside. Now I'm jumping ahead a little bit, but this is that chart I think is so important, because they ask me all the time, like, why is Bitcoin down? And explain it. I'm like, have you seen the TLT ETF that tracks the long bond? It's down the most ever this year, 25%. So everything is down.
Yeah, and of course, actually, the piece I wrote today, and I've only got this chart. But in the piece I wrote today, I've actually got this chart over 5 years, 4.5 years, which takes you to the Bitcoin peak, and the pre-COVID version. And Bitcoin's not so hilarious. I mean, I think that I made the joke today that the Ponzi scheme's gone down this year, and of course, which Ponzi scheme was I referring to?
Exactly.
Not Bitcoin. That's not the Ponzi scheme. So wrong answer if you think that's the Ponzi scheme. So we'll move on. And I just want to go back to a bit of history and talk about the everything bubble, which is a sort of phrase that's doing the rounds. And here we've taken the S&P 500 over 40 years, compared it to the 30-year zero coupon bond. And there's a couple of points that are interesting. Firstly, that when you strip out yield from bonds and equities and just look at the capital side of the equation against high duration 30-year bonds, you get a sort of mean reverting series. Now, I haven't shown the 70s where equities did outperform bonds consistently in a high inflation era. Now, if that is correct, then expect equities to keep outperforming bonds for the next 10 years. But what we're seeing from markets is inflation expectations easing back as the Fed want to slam on the brakes. And we'll come to that, Mike, in a sec. But I was going to talk us through this chart a little bit more. When the line is very high, it means equities have done extremely well against bonds. And that has preceded all the major corrections in markets. So we had the 1987 crash, ironically, comes out quite small on this scale. But look at the speed of the move from 1985 to 1987. And the speed of the move, I think, is as important as the scale of the move. Again, in dot-com bubble, equities race it. And back then, the long bond had a 4% real yield. Before the credit crisis, we got another signal, late 2018 and today. And I would highlight that in late 18, when we had that problem in markets, Bitcoin was the first to fall. Once again, it was the leading indicator, part of my canary in the gold mine thesis. But Mark, talking through this chart, where do you think we are? Do you think equities are cheap against bonds for the next decade, and this line carries on going up, or do you think this is the peak of the everything bubble and down it goes?
I just love your questions, Charlie. I can't wait to hang out with you and meet you more in person. Because to me, the bias here is, at first I have to admit where I was wrong. I was thinking beginning of this year, the place to start looking to allocate capital is U.S. Treasury long bonds, gold, and Bitcoin. Yes, a bit early. Now we had the war kick in, and I view the next decade, maybe more, maybe less, that the bond market, Treasury bonds, we're going to go back to a deflationary period. We're way overdue for an underperformance period in the stock market. That's not profound at all after what we just did, and an outperformance period in alts. And I think part of that's going to be bond yields going back to what they were doing, declining after we get through this rate hike today. And gold being one of the primary assets, and Bitcoin to appreciate more. Now, I've been early, but your chart just shows, okay, quite very simple question, risk reward. What do you want to do here? Buy or sell? And I think responsible risk managers know, okay, I should be looking to respond responsibly to this high elevated level of that chart.
Yeah, the only thing that would make me want to buy this chart is the fact that there was a lot of inflation coming, and therefore the long bond is just literally going all the way down to a very, very low number, like it was in 1974.
Well, that's the key. You go ahead. I didn't mean to interrupt you.
Yeah, and I mean, that is the scenario that makes you want to buy this chart, but it just seems quite unlikely at this point, because the markets have this feeling that inflation is peaking, and that feeling comes from the break-evens. The break-evens haven't been rising this last month. The bond yields have been rising. On Friday, the bond yield spiked on Friday in response to the CPI data, but the break-evens, the expectations of future inflation, aren't going up. Now, this is one of the big things in markets. Are break-evens pretty useless at risk-off periods because they're not as liquid as treasuries, and so people kind of dump tips and buy treasuries, and so they understate future inflation during times of crisis. And that's what some people were saying in 2008, saying they were overstating the deflation shock. And of course, people like me and the Fed and others are using that as a signal. And so if that's true, and it's basically a liquidity sell-off, then maybe maybe the market doesn't actually know what inflation is going to be.
Well, I agree with what the market's looking forward to on that one. My thought is we are going to enter one of the biggest, most significant deflationary periods in our lifetimes. And that's partly because of, first of all, the higher base and what really pushed us. And typically these things happen when asset prices go up too much and they revert. I hate to say it, but I'm reverting very similar to 1929. But we are in such a paradigm shifting period right now where technology is advancing so rapidly that the key thing I see going forward is commodities. To say that they're going to dump after they pump is not profound at all. That's what they always do. It's just a question from where. 2008, the crude oil peaked at 145 and dropped to 140. I fully expect that to happen. That's the number one driver this year so far of inflation, is rising energy prices. I certainly have to tell you in Europe, and I'm based in the US, it's much easier, but spiking energy will revert, and you're seeing those signs everywhere. Just recently in the US, we had the lowest consumer confidence measure ever since 1978. So it's kicking in. I'm seeing demand destruction everywhere. And the key thing that has been driving this crushing inflation for the last 3 years is accelerating. And that's North America energy production exceeding consumption. It's a blip right now, but put ourselves a year from now, particularly if we have declining stock market, I see what's going to be is potentially a great recession and the great reversion in early days, which is part of the reason I'm very bullish gold. It's just you can't have gold anymore without Bitcoin in that same bucket.
Mike had not been paid to join this webinar, can I just assure you?
Well, that's kind of the reason we not at all. We hooked up right away. It was like we had similar views, and sometimes it's better to just disagree. So I hope we can have some good disagreements, let the viewers decide. But it's just one of those things that I love to point out these facts, and I publish on it. These are just things I've published already, and it's, I like to say, hey, my job is to put out a view. If you disagree and say McGlone's an idiot, fine, but you're going to want that view from me. The last thing you want is a buy side or sell side view, and that's the last thing. I'm neutral.
Good, glad to hear it. I take pride in being neutral. It took years to get there, but I think that impartiality is the only way to do this job well. And, I've never been in love with any asset in my life, including gold and Bitcoin. My analysis takes me there. So on that note, by the way, ladies and gentlemen, I'd be surprised there are many ladies listening to this interview, this discussion. Please put in questions, and when we get through some of these slides, then we'll come to them, because I think sometimes the best content can come from good questions. We're talking about gold and Bitcoin, so please don't ask about Ethereum or platinum or anything other than gold and Bitcoin. So, Mike, talk us through this one.
Yeah, so the key thing to remember about gold, it's the most investable commodity ever. I mean, some of us stored on our bodies. There's no carry. Typically, you can buy a physical ETF. You don't have to worry about rolling futures. If you buy things like any commodity, you have to pay over time. You have to pay for that storage in an ETF or not, and it's done through carry and futures. And that's kind of what I show you here. If you just look at the spot gold price divided by the Bloomberg Commodity Index total return, which means the one that investors get. What's the trend? Just simplistically, what's the trend over time? Clearly, gold outperforms most commodities, particularly when they're from an investment standpoint. I just look at this as, okay, there's a blip in the trend. Is it over? Has it changed? And I view it as, okay, prudent money management means I probably should be waving in a little bit gold relative to other assets. And the key driver, I think, well, once we see a little peak in U.S. bond yields, and yes, I have to admit I'm U.S.-centric, I'm American, you can tell by the accent, but that's the key things that drive it. I'm out to anything that drives markets is all I care about. And once that yield peaks, which could be today, because I think the Federal Reserve is going to be, this might be the last hike, and I can get in that later. The gold is typically one of the best commodities to hold over time. If you look at crude oil, I can show you that, we can dig in that later. Typically, it'll cost you about 6 to 8% annually to hold those futures and roll them. Right now, you're getting paid, but over time, you have to roll into contango.
So to remind everyone, we've got the Fed tonight, and they're going to hike. Everyone knows that. And they hiked in March to 50 basis points, 0.5%. And they hiked again in May to 1%. And what's going to happen tonight, Mike?
Well, they're going to go 75. It's priced in the market, and the problem is they're somewhat baited into that by one bad inflation number, and the fact that everybody knows the Fed is feeling a bit squeamish here because they missed inflation last year. I did too, admit that. But now looking forward, at the beginning of the year, they were expected to go 25 basis points at each meeting. Now we're going 75. Now they might go 50. The problem if they go 50 is they're going to goose the stock market, and that's the last thing they do. They need to push the stock market lower. That's my view, and that's what's been happening. So once they go 75, if the stock market keeps declining, which I expect, this might be the last one. The next meeting is July 27th. It's a month and a half from now. Let's see if we get another 10% drop in the S&P 500. That's down 1/3 on the year. And I think you're going to see the trickle down in everything. And it's happening everywhere. I'm seeing peaking. We've seen Amazon decline. The most significant retail stock on the planet, Walmart, Target in this country, everything is tilting towards simple reversion of something that got too far. The Fed now is tightening as global GDP is plunging. Then we have a Bloomberg global GDP tracker. At the beginning of the year it was 5%. Now it's 0, and it looks forward. Consumer sentiment's plunging. And to me, this is the making of, we're going to look back at this as the way you might put peaks in Fed tightening, is when they go really a lot when everything's starting to turn lower.
Yeah, interesting. I mean, so you sort of still feel that they're very much the Fed put to some degree is still in place, despite what they say. You think that if the stock market falls too much, they'll ease back.
That's what I'm worried about. Is they'll ease from the tightening when the market tells them to. That's not an if, that's a when. It's just a matter of time. It always happens that way. Just look at the 1987 stock market crash. As the Fed was tightening, the market dropped 20%, and they started easing that night, that day. Okay, so let's say if we drop another 10%, they'll just stop tightening. The problem is, from the future, for a generation now, humans have learned the limits of unprecedented monetary and fiscal stimulus and what it does to inflation. They'll be just like the Germany after the World War II. Oh, we have to always worry about inflation, right? That sentiment's ingrained now, particularly in this country. And anytime we talk about Fed easing in the future, we'll be like, nope, we can't have inflation. So to me, that's the headwind for equities. That's going to be consist for quite a while, and we're going to have plenty of deflation kick in, because that's going to be much lagging. The Fed's only going to ease when it's clear that whites of the eyes of deflation are kicking in, and that's what I expect. Just human nature, which will never change, and that's what I see kicking in. Today, we're in the midst of that. Fed's going to tighten more than anybody expected just 6 months ago, as everything's starting to collapse. I mean, just what's GDP doing in Europe? What are the estimates in China? It's just they're collapsing. It's just it's just epic stuff you're going to write or tell our grandkids about.
And you get some evidence about this. Part of the fact that there's been too much risk on, or too much sort of bubbles in stock markets and so on, is the gap between gold and commodities. Do you want to talk us through that?
Yeah. So the key thing, the big gap right now is commodities. I just like to use a simple relative value. How markets move relative to history? What does that mean? So here I'm using Bloomberg Commodity Index versus its 200-week moving average. It's just got the most stretched ever since 1980. And we had similar examples in the past. As you don't want to be long commodities when it gets that stretch above this mean. Now I use the 200-week because the 100-week was kind of dicey a little bit because of what happened with COVID. But you use the same thing versus, I'm sorry, I'm using the 100-week here. I think I can, 100-week. Gold has been stuck on that average for almost a year now, which means it's about as trend ready as it gets. Gold is cheap, commodities are expensive. This is very rare. In the past, what you've seen when we've had commodities rally, gold was a leading commodity to rally. What have we seen in this time? It points to me that gold is the most trend ready, ripe to rally commodity potentially on the planet, potentially asset on the planet. And commodities also needs a little trigger, like we're seeing with copper going down the year, industrial metals going down the year, natural gas in the U.S. plunging yesterday, are signs that we're starting to break the commodity rally, and it's just going to do what it always has. It collapses when they go fast. And that's not profound. It's what it did in 2008. And I think that's going to happen this year. I think gold's going to be the primary beneficiary.
I mean, the other point here is a really simple one, but commodities are supposed to be interesting and gold is supposed to be boring. Isn't that the point? And you have all the fun in the right kind of bull market that's very much commodity driven, like the one we've just had, or like the one in 2005 era. That was quite a lot of fun for commodities. Indeed, the recovery in 16, you get these occasional surges, but commodities are really sort of spring to life every now and then settle down for 5 or 6 years. And when people go back to the 70s and say how much fun commodities were, but they were also excruciatingly volatile, weren't they? And in fact, I mean, even gold was volatile in 1980, wasn't it?
Well, look, you can see that in the chart. And the key thing to remember is called, and we all know this, supply and demand elasticity. That's the thing that's always going to work against broad commodities. Why is the U.S. now the world's largest energy producer and net exporter of LNG? Because prices went up a lot in the past. The U.S. harnessed that technology, maybe luckily, and now we have massive excess supply. Okay, why is crude oil still well below the peak from 2008? That's the key difference with gold and Bitcoin. Gold is the least elastic of all commodities. It's hard to bring out more supply of gold. I mean, it's the best of everything we've ever come up in the world for a solid form of money, except Bitcoin is the new version. And the key thing I like to point out is when I remember really understanding that supply trajectory of Bitcoin by code, 900 a day, 2 years from now, that's going to drop to 450. You cannot increase the supply of Bitcoin other than by code. All that matters is demand and adoption. And that's why I put it in with gold. And that's where commodities are different. Not with just technology, but with normal human innovation and normal elasticity. We're going to plunge the demand, increase the supply of all commodities, but can't do that with Bitcoin. And gold is the one that's kind of in between.
Yeah. And so you make that very good point. We'll sort of jump to Bitcoin briefly. The US regulator is talking about treating crypto as commodities, which to my mind makes complete sense, because commodity supply tends to be pretty stable most of the time. Occasionally you get a crisis, but generally it's stable and demand is all over the place. And that is exactly what crypto does, isn't it?
Well, that's part of what you see from this chart too, is that one of the key indicators where gold will bottom is when the bond markets peak. Now, I started in the trading pits in the U.S. Treasury bond futures pit and Chicago Board of Trade, and that's been around since 1978. And relative to its 100-week, its 200-week moving average, is only one time in history it's dipped to where it is now. This sharp correction was 1978, I think. It was a pretty long time. But the key point is what you see in terms of yield is I fully expect what gold's going to do is it's going to bottom when we see a little peak in yield. And that's what happened was right around 2014 when gold broke above $1,400 an ounce. It's right when bond yields peaked. And remember, the bottom in 2015 was when the Fed raised rates, and the markets start looking ahead to the end game. So to me, that's where gold's going to break out. Right now, we're in that stage that the Fed's raising rates. It's at, you can in 2-year note yield, you can get right now 3%. A year ago was 1.5%. But at some point, that's going to hit the inflection point, which might be today. And I think gold will come out ahead. But what it needs right now is those yields and rates to just stop going up. And that's going to be a key indicator for gold to break out of its range, I think.
Yeah, it's very painful, the bond yield doing that, which neatly brings us on to how I look at gold. And there are 3 components to this. Firstly, it's a 20-year tip. So I'm sure some of you will be familiar with this, anyone who reads my work. But it's a 20-year tips with no yield. And there are 3 components to that. One is past inflation. So when we saw CPI printed last Friday for 1%, that goes into gold's NAV for the long term. So gold forever ever gains 1% of intrinsic value forever and a day. And the second component is real interest rates today, which Mike's just been talking about, which at the moment are not being driven by inflation expectations because they're not moving, but it's the bond yield that's really killing gold, that's rising so much. And the final point is that there's future debasement. So if you're $100 today, will only be worth $50 in 20 years time in terms of purchasing power. So gold will compensate you for that, just like a tips will. And this bond yield shooting up has really caused the fair value, the grey line, to come down the last couple of months. Now, Mike's given a lot of good reasons why they can shake that off, and indeed, that's a 10% or 15% premium. It's not the end of the world, and that's happened many times before. But basically, I think what's quite interesting about this is that gold was dirt cheap in the years 1999 to 2000, and that was after a 20-year bear market, a very period of tight money. And 20 years before that, in 1982, the chart I was showing you earlier, people had given up on financial assets, people had given up on bonds and given up on equities, and gold was all the rage. And it just reversed over the next 20 years, and investors gave up on gold. And now I don't think gold's at a particularly special point in history in terms of valuation. I think it's there or thereabouts where it ought to be, a little bit high on this measure. If we get the inflation, it's dirt cheap. If the rates stop rising, as Mike suggests, then that grey line will retreat quite quickly, and gold again will be well supported. But that's how we think about it. And it's not that you can't own something that's overvalued. It's just your expected return is lower when something is above fair value, and it's it's higher when it's below fair value. And I think the point here, Mike, I'm talking about inflation hedges. People have been criticizing Bitcoin for not being an inflation hedge in 2022, and gold for not being an inflation hedge in 2021. And I would say that there it was in 2022 saying, look at all this money being printed. There you go. It gave you all the return it ever planned to give you early on, and that's it. And of course, going back to 2011, there wasn't much inflation in that era, but the market was worried about it for a short while, and we had a bubble. But my simple thesis, Mike, is that an inflation hedge only works if it's correctly valued. You can't expect Bitcoin to be a great inflation hedge at $68,000 in the same way it might be at $10,000. The same is true for gold and everything else.
Yeah, well, I like that what you started out with, that the sentiment was pretty bad for gold and things in the year 2000, and it was good for stocks. The pendulum always swings. It's just swung back to sentiment for gold is about the worst I've ever seen. I mean, stuck in this range, and sentiment for equities and risk assets and cryptos and condos in Miami and things were about the highest I've ever seen it just a year ago. That's going to swing back, and I think it'll be a long time before it's time to go buy equities. And now it's time for gold to shine. The key thing to remember I love about this inflation hedge is gold. There's probably no better example in history of a better performing asset than Bitcoin. And when the Fed takes away the punch bowl and we have some reversion risk assets, you got to expect that asset to pull back. And it is. So if I just remember the last key level for Bitcoin was around 5,000. That was near the low in 2018. That was kind of the dip in 2020. And right now with 21,000 on the screen, it's still 4 times that low. Okay, it went too high. Now it's coming back to really good fair value. Just like Bitcoin, historically, just like gold, I view gold as almost as attractive now as it was in 1999. And I fully expect that kind of next appreciation. But the difference is, this old analog is being placed by the digital. I just can't take the risk, even as a strategist, of saying, I'm bullish gold without having that digital in space, because we clearly know it's replacing the old analog.
Well, maybe. And And do you want to talk about this one quickly, and then we'll come back? I thought we were going to go to Bitcoin then. Yeah, go for it.
The number one thing to think about, I think, is what I'm showing here in white is gold, the gold spot price divided by the Bloomberg Spot Commodity Index. Now it's coming back to really good support level. Now that's just the spot index. So it shows only pure value. Spot index is not investable. It just doesn't work that way. And what I show you is crude oil divided by the Bloomberg Spot Commodity Index. Historically, you can't invest in crude oil, but even the spot price is underperforming commodities. So I view what's happening is crude oil is bumping up against good resistance historically against all commodities. I mean, in this country, we're replacing, I drive an EV, and in 10 years, we're all going to drive EVs. Just normal technology advancement. But gold is bumping up, and so crude oil bumping up in good resistance, gold bumping up in good support relative to the commodity market. It's just relative value. I look at bullish gold and bearish crude oil.
Yeah, so what you're saying, that chart is another way of saying that an ounce of gold will currently buy you 15 barrels of oil. And 2 years ago, so I'll talk about Brent rather than WTI, because the chart's been ruined by being going negative. We can never use that chart ever again, unfortunately. So we had to use Brent, and you would have bought an ounce of gold would have bought 70 barrels of Brent in April 2020. And the same sort of thinking in 2008, before the credit crisis, an ounce of gold would have only bought you 7 barrels of oil. And in 2009, after the credit crisis, when oil had crashed, it would have bought you 20 barrels. So actually, if at the crash of 2009, you got 20 barrels of oil for 1 ounce of gold, and say you're only getting 15, maybe oil's not a bubble. Maybe that's
I mean, it's a little bit. I mean, I'm glad you mentioned Brent. And what happened with Brent? Brent was just a good example of, they were able to find it at the right price. And that's what happened with shale. We were able to find the supply at the right price. Starting in 2014, really kicked in. And what's going to happen in the next 5-10 years? We're not going to need it as much. And I look in this country, I don't ever want to be bullish. I pointed, I don't like to be bullish commodities that you can grow. You can grow ethanol. I used to own a farm. We can grow petroleum. You just plant it and it grows. I mean, it's not perfect, but you can grow it. You cannot grow the metals, number one, and the most restricted supply metal ever in big picture in the macro is gold.
So, I mean, on commodities, before we leave, go back to Bitcoin, my strategy of commodities has always been gold, and then I do a bit of silver and other precious metals sometimes, but basically it's gold, and then there's a sort of a view on oil, and I kind of don't worry about the other stuff too much. A little bit of copper through the mining stocks, but I kind of think it's all about get gold and oil right, and the rest of it doesn't matter. Do you think I'm being lazy, or do you think that's an efficient approach?
Darn, we think too much alike. So I focus on the macro just like you. We focus on the force, and that's the force. The trees will kind of confuse you. Like nickel this year it's becoming significant, but it just made you lose your hair. And just the key thing I liked is that's the key fact. And since I kind of look at the indices, I look at the macro, and that's the number one pair in all commodities: gold versus crude oil. And then I look at copper versus crude oil, the ones that matters. And the only one that really matters, the most significant in ags, is corn. So it's the 3 C's: crude, corn, and copper are really ones, and gold is the precious. So everything else is just kind of noise. But in crude oil, there's also the derivative of natural gas, and key thing about these things is we're not going to be needing them much in 10 years, and that's something that's never happened in terms of, except things like whale oil and coal and cordwood.
Well, I am waiting for the first year for Brent crude global demand to be lower than the previous year outside of recession. When that happens, I'm going to buy and embrace the green arguments.
So let me point you out a simple fact about that. The world's largest demand pull source of imported crude oil was North America, most notably the U.S. Peak consumption in the U.S., North America, let's use U.S. and Canada, it was about 2010 18, maybe 19, 24 million barrels a day of liquid fuel. That includes crude oil and everything else. That's dropped to now 20, it's bumping up to now 23. Yet total liquid fuel consumption in North America is around 27 million barrels. I include Canada because they're all linked and they don't have any access to export. They can't export as easy as many other countries. So that is the key paradigm shift in the world that keeps me bearish crude oil in this environment. Is that was not the case in 2008, and going forward, where's that going to be? So people say you never have demand elongated commodity rallies because of supply shocks. It's got to be demand pull. And I just point out the key fact is consumer consumption of liquid fuels in the U.S. is actually declining, and that's just based on efficiency. Now, where's that going to go? And the changing demographics. Where's that going to go as the world shifts to EVs?
And you're also making the point that oil's not an investable. The commodity, is not an investable asset like gold, the commodity, is. Because gold wouldn't do this, because actually what you've got here is an oil price that's approximately the same in early 2008 to the present day. And by buying futures and rolling them, you've had a disaster, down 86%, right?
Well, that's the key thing to remember about all commodities. Unless you're buying the producers, I've been very bullish on the producers this year. Now that's somewhat changing as we probably peak. These are what I'm showing in this chart. I'm glad you brought this up. Is in white that's the GLD. That's the top gold ETF on the planet. There's some big ones in Europe too, but just look at the performance since since the start of 2008, 100%. And the standard, the top commodity ETF outside of GLD is USO that tracks WTI. It's down 86%. Sure, it's had problems with rolling, but that's the key thing to always think about gold versus anything else. Is you can buy the physical, you can store it, it's easy, no problem. Any other commodity, you're going to always have issues with rolling. Yes, they'll work out the issues. Yes, right now they're in backwardation. You get positive returns, but over time, you're always going to have to pay that cost of storage. And just look at the metals are the easiest, simplistic to store. You can, put copper in your basement and forget about it. It's fine, but you can't do it with crude oil.
Yeah, but you need a lot of space to store that copper, don't you?
Yeah, well, even aluminum will oxidize, and so does copper. But that's for gold. Drop in the bottom of the ocean. It's the same thing 2,000 years from now, and that's where in this digital world, Bitcoin is becoming similar as far as its immutability.
Now, we've done a lot of gold on this conversation, and we always get in trouble, Charlie and Eric and I, when we do these webinars, that we do too much gold, not enough Bitcoin. But I think, we do about 80% gold and about 20% Bitcoin, which is roughly the gold index. So that's about right. But anyway, here is the valuation of Bitcoin. And this methodology I started doing it was the 31st of July, 2014. Was when we first did this, and we had no idea what it meant, no idea what the NVT was supposed to be. But basically, the idea is that Bitcoin's got one job, and that is to transfer value over the blockchain. When Buffett said the other day that if you buy all of the Bitcoins for $25, he said he wouldn't buy all the Bitcoins for $25, and nor should he, because if you owned all the Bitcoins, you would destroy the network and they'd be worth $0. So you actually want to own some of them. You want some of the Bitcoins, and you want everyone else to have the rest of them. And the most active, valuable network possible will be everyone owning a little bit, doing lots with it, moving it around, and all the rest of it. And if everyone did that, then Bitcoin would be a huge liquid market and would become the new gold, basically. So that is the aim here, to become a big, liquid, active, useful market. And in the same way, gold, the pet rock will be in a liquid gold. If we just bought gold, like this is my real bar of gold, absolutely real. There's no fake plastic on the back at all. But if we all just did that and that was gold, it wouldn't be worth nearly as much as liquid gold, the financial market, which deserves a liquidity premium, right? And I think that it's a network, it's a go-to, it's a 5,000 years of trust and all those things. And so I think that gold, the pet rock, as in the element, is worth less than gold, the financial asset. What's the difference? I don't know. There's got to be a difference. And so it's true with Bitcoin, the financial asset has got to be worth more than Bitcoin, the bit of computer code, or the Ponzi scheme, or whatever people want to call it. But I think that this relationship has stood 10 years, and this is how much money transfers over the Bitcoin blockchain relative to to price or market cap in any given week. And what we're saying here is that at 10 times NVT, network to transaction value ratio, then when that's the case, then that's sort of been some kind of average. This number was very low in sort of 2016, 15, 16, when the network was half asleep and people were sort of wondering whether it would ever wake up again. It did wake up, very much so. But for some reason, the NVT kind of took a new range the last 4 or 5 years. And I think that many of us got into the feet, drank the Kool-Aid and said, yeah, that's real. That's the new range. Because it's so young, you don't really know. But then we're going to find out in the next 2 years whether Bitcoin wants to hover around NVT 10, which is, by the way, what we have on our website, the live version. But then, my colleagues and I, we've been writing all sorts of excuses about, why Bitcoin is not overvalued. And of course, maybe it was. Maybe this is back to basics. What do you think of it? I know you followed NVT, right?
I used it a lot more a few years ago, and I like it. I think it's good. We talked about this earlier. I have similar charts, so the same thing. And I like to look at, I've kind of kicked it down to my KISS method, keeping it more simple. Is I've used very similar measures versus 100-week moving average. It shows the same thing versus supply and demand. We've heard stocks to use, and they all kind of come up with similar narratives. I fully think that Bitcoin now is getting into a very similar situation around 5,000. It's basically 21,000. It's basically similar to around 5,000 in 2018 and 2020. Now, it did fluctuate a little bit around below that, but that made it's building a foundation and a base to the next level, and which was similar to around 300 back around 2013. The way it's doing it, the way I look at it is, it's unless the greater risk, and I've sensed this every place I go now, I think most people are getting the greater risk is not being allocated to this nascent asset technology, and for it just continuing to do what it has been in a world going digital. We all saw what happened with things like Blockbuster and Kodak. And yes, I'm obviously American-centric, but to me, that's what the professionals get. And this thing it's survived the trials of 1,000 cuts. And I'm classic, zealot like a convert. When I first heard about it from my eldest son about a decade ago, it's silly internet money, but every day that goes by, it just proves me wrong. Like when what I knew this week, the markets were going to collapse when I looked at Bitcoin on Saturday morning US and saw Bitcoin was going down. Not just Bitcoin, but it meant everything's going down. You have never been able to do that with any other asset in the history of mankind on a global basis. You'll get price discovery 24/7 on a fluid asset that's no one's liability in a decentralized network that's just basically open source software. I mean, for some of that stuff I just said, I don't even understand it, but that's where the world's going. You want to take the risk of us just falling behind and going back to horse and buggies? I'm like, got to have some Bitcoin. And I just look at it that simplistically, and particularly overweight when it gets a little cheap, like I think it is now, and underweight when it gets expensive. But overall, you got to have some versus the risk of not partaking in what it has been doing for the last at least decade.
Great, Mike. Well, I think that let's go. We've done 40 minutes now. We've got a few questions, so I'll pile into those. Patricia, she quotes Ray Dalio, who says he would take the gold and sprinkle a little bit of Bitcoin into that mix too. That's a quote that we are very grateful for here at ByteTree. It's on all our presentations. Thank you, Ray Dalio. So Patricia's question is, what are your views on the future regulations for Bitcoin, particularly in the UK? Maybe you could talk about the US and I'll try and have a go at the UK.
It's historic right now. We have this bill from bipartisan. It's the Lummis Gillibrand bill. Females, bipartisan, Democrat, Republican. It's about as good as it can get. I mean, it's just exactly what I had pointed out a year ago when China pushed back. And it's what I just love. It's back to Churchill when he said Americans will finally do the right thing when pushed to the wall or pushed to extremes or something like that. And it's just exactly what's happening. That the U.S. is embracing this space of rapidly advancing technology with proper regulation. It's not perfect, and it's going to be knocked around, and there's going to be all these horrible headlines, but they're getting to it, and that's what matters. And it's just a matter of time. And the fact that this bill is bipartisan and it's also becoming the key fact in the States is that I like to point out is it's not going to be messed up because what's the most widely traded crypto on the planet? It's the buck. Tether is a digital token that tracks the dollar. It has double the volume typically. Bitcoin, if you look at all the crypto dollars that people call stable coins, they're all being made possible by this technology. And what U.S. politicians are going to mess that up? And also it has jobs, money, votes, and revenue. And if you're not positive crypto, you're not getting as much revenue to get reelected. It's just win-win from if you understand politics. And the question is proper regulation. It's just going to take a while.
Right, Mike, I think this is quite a good one. Okay, you said deflation is the man, but you talk about an inflation hedge. Which is it? So I think we'll probably both take that. You go first. So the question is it your views? I think you've been saying that we face a deflation shock in the coming years, or next year, I think you said. And how does Bitcoin and gold fit into that?
So typically Bitcoin and gold, gold has been performing much better in the last decade or so in a deflationary environment. Inflation had, yes, great. If you're in a country, we have a massively deflating currency, which we've seen in the yen. This right now is down 14% on the year. The euro is down 8% in the year. Gold has made new highs in terms of the euro and the yen. It's doing what it's supposed to. It's that stable force. That's the monetary force of deflation always, of inflation or deflation. But the key fact I like to point out in terms of dollar-based is the bigger risk, I think, is what you're going to see happen today. Fed's going to raise 75. You're seeing deflated risk assets, and gold's going to come out ahead as bond yields decline. The old days of massive inflation in terms of a base currency like the dollar, sure, if the dollar collapses, gold will do fine, but the dollar is unlikely to collapse. It's that more deflationary environment. And I just like, how's gold doing in terms of euro and the yen this year? It's made new highs. That's because the currencies have basically been debased versus the dollar.
Yes, I think that first chart I showed of gold up 1% in dollars this year, the last 6 months. I think you can add a zero onto that. I think it's more like 10 if you put it into a typical developed world currency, and if you look at it into a basket case currency, then it's better than that. So we take that point, but in that sense, the high inflation is kind of the denominator rather than the numerator, isn't it? So if you put gold in Turkey or whatever, then you get
Turkey. There you go. It's a good example.
Ignores it, but So I mean, I'll try and answer that question. I think that. That inflation is something that's cyclical. It comes and goes every cycle, and slowdowns tend to be deflationary or disinflationary, and recoveries, more demand tends to be inflationary. When you get structurally higher inflation either for macro shock, like supply chain shock, like we've had recently, or huge money printing, all these things. I mean, I'd probably be more in the inflation camp than Mike. But I have to say that this is complex macroeconomics. The central bankers don't understand it, and the economists don't understand it. So I don't think there's any reason why I should understand it. But you're ready for it, and the portfolio should be ready for different scenarios, and that's kind of the point here. But I think that Bitcoin it's very simple. In the reflationary risk ons, Bitcoin does well, and in the disinflationary risk off, gold does well. What we haven't seen since the 70s is gold really perform in an inflationary environment, and that's because it was the last time we had a proper developed market currency, big inflationary environment. Many people think that what we've seen in this year and last year is a taste of one of those coming, but it may or may not be. We don't know.
Well, one of the key things too about last few years for gold is why high velocity, and it's just sucking all that capital. But now it's not, and that's probably changed. So that to me was one of the key headwinds. And now we have the Fed raising rates, so you can get these risk-free securities at 3% for a year. Now it's a bit of a headwind, but good old days of inflation in the 70s. Those of us who grew up with it, those days are over. And we've just had a blip. The key thing I want to point out, I'll end with this, is the U.S. M2 money supply last year peaked at 26%. That's the highest in our database since 1960. Now it's plunging. I mean, it's actually going down as fast as it went down. In fact, last month was the first down month in a decade. So what's going to happen? The central banks, most know the Fed, is just going to keep raising rates until something breaks. And what's happened is already breaking. We're seeing massive deflation of risk assets. Early days.
Okay, from Jeremy, if the Fed funds rate goes to say 5%, it's still well below the level of realized inflation today. In other words, that's what sort of 8.6 on US CPI. but I guess there's expectations to consider. But it's unlikely the Fed will go to 5% rates, isn't it? What is the implication for gold and Bitcoin if it did? Can I just take that first and say, well, if the Fed went to 5% rates because the inflation proved real, that means expectations will be much higher than they currently are as well. So actually, they gold particularly could be fine in that environment. But it all depends. I mean, it's like, it sounds like an awful answer, but that's half the question. So the scenario is Fed funds go to 5%. What, with tons of inflation, with existing inflation, with even more? If there's even more or existing rate of inflation is deemed to be permanent or structural, then yeah, absolutely, gold is going up. If they're doing it because they're being Paul Volcker and they want to smash the system, then I think gold goes down, but everything, equities go down a lot faster. But that's a pretty nasty environment. And then we got a comedian in the room. We've got Lee, who must have listened to us earlier. Said, what about silver? Didn't I say no questions on silver? Or was that platinum? I think I quoted platinum. But actually, we can talk about silver since no one's asking anything else. So let's finish off on that. Come on, Mike. What do you think of silver?
Gold, silver, platinum, palladium, I think belong in a bucket together. And I've always liked those combined. Obviously, overweighted gold, but you get some of that major upside industrial type metals in platinum and palladium. Silver, you get the leveraged gold. And the key thing about silver right now is there's so much more linked to copper because they're more industrial, and copper is down in the year for a reason because the world heading towards recession, potentially global depression for an extended period. I mean, look at China. GDP is down to 2%. You really believe their GDP anyhow? So I like them all together. The key thing to remember about silver, though, is it's basically leveraged gold. It's more like copper. And again, as a diversified portfolio, I think they all fit in pretty well together.
So my answer on silver will be the gold-silver ratio is 85 right now.
Yeah.
And, if you strip out, what happened in COVID, then it's kind of the highest it's ever been in history. I mean, I'm talking about hundreds of years of history. So silver on some measures is really cheap, and I think one of the reasons it's cheap is because crypto came along, and so if you go to thin Twitch, financial Twitter, and you get all the idiots talking about this, that, and the other going to $1 million, they would have been talking, if crypto didn't exist, they would be talking about silver. And so the fact is they've all got bored of silver. So silver hasn't got the normal crowd, and therefore it hasn't got the premium. So I think silver is undervalued. Therefore, it's buy it. So I'm very comfortable owning silver. I think that when it's cheap gold, when silver is cheap gold, then that's great. But when it's trading at a premium to gold, then that's dangerous. So I think it's as simple as that.
Can't argue with that. I just like the diversified of the precious metals: gold, silver, platinum, palladium, Bitcoin.
Nice one. So, Mike, do you have any final words?
Oh, first of all, thanks for having me. I'm looking forward to meeting you. Maybe, hopefully, when I'm in London in September, I'll be busy, but hopefully I'll be able to hook up with you. And I think the key thing to think about is the reason I really was compelled to speak to you about this is speaking to you about the bold index. I don't promote anything, and I get a lot of people always asking me to help promote stuff. I just found what you did in that index is very compelling. The volatility weighted, 20% Bitcoin might be a little bit high, but that's volatility weighted. And I think it's really reflective of what's so important looking forward in the future. You cannot take that risk. I can't, as a strategist, of not having Bitcoin in that gold bucket. And the fact that China and Russia are really, most notably China's really pushed back and put all their risk into gold and pushing back on cryptos and Bitcoin, I think it's part of this major shift in the global paradigm shift that's really going to maybe push back those old guard societies in favor of the ones that are willing to really accept this new technology. And one thing I want to leave you with, a lesson I learned is don't mess with the Swiss. And they're one of the most, they kind of embracing cryptos in that country, I hear.
Switzerland is the model to follow in kind of everything, in their political system. I'm not sure about their food so much, but they do a good hot dog. Anyway, Mike says he's looking forward to seeing me when he comes over from Miami. Now, you've got to question someone's integrity. When someone who's living in Miami says they're looking forward to coming to the UK, you've got to wonder about that. I mean, anyone in the UK wants to go and live in Miami, so there you have it. But Mike, thank you very much for your time. That's been a really good discussion. And thank you everyone for listening. And remember, you heard no investment advice today anywhere in this conversation.